More on the potential for returns from emerging markets. Let's hear what Philip Poole has to say. He's head of investment strategy at HSBC Global Asset Management, which manages more than $450 billion in assets. Philip, good to see you. So it seems there's plenty of money sloshing about, and it's all headed to emerging markets, which of course aggravates the inflation issue. But is that where you want to find your returns as an investor?
I think it is, actually, yes. I mean, we're in a very low yield environment still in the developed world. As you say, there's still a lot of money in the system. QE2 may have come to an end, but the world is essentially still flooded with liquidity and little yield on offer in the developed world. So I think if you look at the emerging world, the credit fundamentals have been improving, and the prospect is of getting higher returns with potentially, of course, currency appreciation associated with that.
But inflation is the big risk in the emerging world. So where's the best places to put your money? Who's ahead of the curve? Who's handling the problem of inflation best?
Yeah, it's true. I mean, for that reason, I tend to stay short in terms of duration. There is still an inflation problem. It's going to be a while before that rolls over. I mean, you've mentioned some of the markets that have been attracting that money. One of the things that I'd be concerned about is India. I think to an extent that's a market where the central bank has been somewhat behind the curve. But generally speaking, if I look at the combination of yields on offer and also the higher likelihood of some currency appreciation to deal with that inflation problem, I think that emerging market local currency assets on balance are a good bet at this point in time.
Which particular currencies do you want to be holding?
You want to hold currencies really where central banks are dealing with the inflation pressure using interest rates rather than quantitative tightening techniques. So I like, for example, Indonesian rupee, Korean won. These are currencies in Asia which I think are still significantly undervalued, where central banks I think have been on top of the story. To my way of thinking, Brazil, currency issues there. The currency is looking fully valued at this point. I don't see the upside, and of course the authorities there have been very concerned about that from a competitiveness point of view. So the yields on offer there are very attractive, but the currency component I think is less attractive now.
All right, let's go to the dark side of the world, the developed markets. How do you describe the soft patch, the sticky patch that we're seeing? Is it becoming more serious?
I think it's very similar, actually, to what happened last year. We had a whole series of concerns that were out there, a soft patch in the US data, the end at that point of QE, the first round of QE anyway, and of course concerns about peripheral Europe. So many of those concerns are there, and we're heading into a quiet time for markets where liquidity generally is reduced over the summer period. So similar situation. I think in reality, if we think about the way this plays out, it strikes me that over the course of the next couple of months, maybe 6 weeks to 2 months, markets probably unlikely to move higher from here. But I think at the end of the summer, it'll be clear that it is a soft patch in the US data. It's not a return to recession. I think it'll also be clear at that point that China is not heading for a hard landing. It's going to be a soft landing. And I think on the back of some resolutions in those areas, we can see markets rallying again before year end. We're
also looking, Philip, of course, for a resolution to U.S. bickering over the deficit there and to the problem of Greece. Do you see a big risk there to this soft patch that you say it's going to remain a soft patch, but what's the risk that it becomes worse?
I think the reality is that the focus on the debt ceiling in the US is really more noise than anything else. I think there'll be an agreement. The thing that concerns me there really is the structural issues around the fiscal deficit, the continued rise in debt to GDP ratio. Something has to be done there within the next 12 months or so. But I think the immediate issue about and concern about the debt ceiling is probably overstated. In terms of Greece, in a sense, what's happening is that the problem's being pushed into the future. It helps, of course, because it helps banks deal with it ultimately. But you know, I think that this initiative will come to fruition. There's still a lot of noise around it with ratings and the ECB's position, etc. But in reality, I think there'll be a deal that's struck. I'm not so sure that it's dealing with the underlying problems, but it'll take the immediate pressure off, certainly from Greece anyway. The risk, of course, for the Eurozone is that there's a need to bring down yields in other areas, in other markets, because that's exactly how contagion happens. So if those yields stay high, you know, the risks will still be there.
Yeah. Okay, Philip Poole there from HSBC. He's head of investment strategy at HSBC Global Asset Management. Thanks very much for being with us.